The market's fully expecting sort of a double cut, 50 basis point cut by March. What would that do to the markets?
Well actually, triple cut. They're looking at 75 basis points. I think it does help put a floor under the stock market. I don't think it does very much for the economy because honestly, it's not interest rate decisions that are driving economic problems right now. But the lower you push long-term rates and lower you push short-term rates, the harder it is to justify being in bonds as opposed to stocks. And I think that does help put some sort of floor under the stock market. But I think for investors, the key thing is to recognize, look, we don't know how deep it is. And that's the problem. We don't know, are we talking about hundreds of deaths in the United States or heaven forbid, thousands of deaths? But if that number grows, then you could have more and more social distancing. That affects services much more than manufacturing. It could put the U.S. in recession, could put the global economy in recession. But what we do know is it won't last forever. You know, I always thought that 2020 was going to be the year of the election. Turns out 2020 is the year of the virus. But it's probably just this year. I mean, at some stage, given advances in medical technology, we'll have a vaccine, we'll have ways of dealing with this. So, you know, if you're a stock investor, I mean, the way I think about it is this. If a PE is 16 times this year's earnings, that means that this year's earnings matter, but they only count for 1/16 of the value. The other 15/16 are value in the next year, the year after that, the year after that. We've got to remember these are long-term investments, and so we don't know how deep the economic hit will be, but we know it won't last forever. So are you saying that if your investment horizon is longer than this year, you should be in the market? Yes, and if your investment horizon is shorter than this year, you should never be invested in stocks.
Your emphasis on the ephemeral nature, we hope, of this is not an argument for the Fed to cut, is it?
No, I think it is an argument for the Fed to cut. I don't normally believe the Fed I think the Fed should have raised rates a lot sooner in the expansion. But no, I think there is a wealth effect from a falling stock market. And so if the Fed cuts rates and that limits the damage to the stock market, I think that will actually help the economy.
Really, we're just talking about saving the stock market.
That's part of it. I mean, I think we also need to think about stuff from the government. I think there are a lot of companies that are probably a little bit more vulnerable, particularly the travel industries and the service industries. What can the government do to try and help some of these companies tide over what could be a pretty rough year?
I mean, Paul, that's quite a statement David just made, that the Fed can actually put a floor under the stock market, even with the big uncertainties around the economy and the virus. Do you agree with that call?
Absolutely. Look, the sorts of declines we've seen in stocks and the buying in bonds, this is an unprecedented stock correction. Puts to calls, no matter how you want to look at it, this has been extreme, and it shows signs of panic. I mean, people are willing to pay $10 for a face mask that used to cost a few cents. That's panic. What the Fed can do. I think a lot more than that. Well, at least for right now, it's panic. If there's downside risk, there's also upside risk that we're not hearing many people talk about here in terms of this coronavirus. So, yes, could the market use some help from the Fed in putting in at least a short-term bottom while we get more information and make a more rational set of decisions? The answer, I think, is yes.
Well, David, you know, we go back to October, things look good on the economic front, and the market rallied significantly on the idea that, well, there's not really that much that stands in front of us right now, and obviously with rates as low as they are, you can understand. So where are we now in terms of if you are looking out, again, to your point, I understand, years from now, certainly, but for the rest of this year and into next year?
Well, I think there is downside risk, but because we have not really seen in the economic numbers yet, apart from the PMIs coming out of China and to some extent the U.S., we haven't really seen a big economic hit. The thing that I worry about from an economic perspective is a hiring freeze. If you see hiring come down in the U.S., that's what could trip us into recession. It's not consumer confidence. I was in Costco over the weekend, and God bless American consumers, and people were piling up pecans for the pandemic. I mean, why do you need pecans? They had enough mustard for generations.
But they last for a long time.
I know, but consumers are very brave. It's businesses that lose their nerve, but that is actually the risk.
Your point. I'm looking at the headlines this morning. Goldman, travel restrictions. Target cancels the Investor Day. Vanguard is cutting all cross-border travel for the foreseeable future. Yep. So who's freaking out more, consumers or companies?
Well, I think businesses have got legal concerns, and there are some genuine concerns, but businesses are cautious about this. They don't want their employees to come down with this virus. A lot of things can be done with telepresence and teleconferencing. So, but businesses generally act in a more prudent fashion. Consumers are actually, when it just comes to the issue of consuming, they're pretty brave.
So last question to you, Paul. I mean, you're talking upside risks and say there's buys out there. Which industries are you looking at?
We think there's still enough worry for the downside and enough uncertainty overall that we want to stick with quality. It's where we've been for the last year. We like good cash flow companies, companies with good cash to debt ratios, companies that have good earnings prospects, and that leads us to still tech, yes, communication services, and consumer discretionary. Those are our favorites. We'd be moving money out of materials and energy.